I'm Anthony Valeri, Director of Investment Management at Zions Wealth. Thank you for joining. Today we'll take a closer look at the S&P 500 and its composition. The S&P 500, a good metric for the US stock market, has roared back since the April lows, up over 30%, but it's created some concentration issues worth a closer look. The main driver of that performance has been mega cap tech, which represents a large portion of the market. In fact, the top 10 companies in the S&P 500 now comprise 40% of the index. The top 10 have never had such a high concentration. It is a record, and the top 5 represent nearly 30% of the index. These companies have delivered impressive earnings growth, but it's important to note this concentration still remains in the market. This concentration also comes at a time of very strong longer-term performance for the S&P 500. Here we take a look at 10-year trailing performance of the S&P 500 index, and for the 10 years ending August of 2025 has returned 13.7%. That is well above the average of 10%. This also brings up a question for investors. Do you want to be this concentrated following a period of very strong performance? We believe ensuring a healthy allocation to the other 490 stocks in the S&P 500 is more prudent now than ever and helps and ensure that you have adequate diversification in your portfolio. As you'll see from the stat on this chart, the median forward performance is 8.7% over the next 10 years, when the prior 10-year trailing return has been 13.5% or more. That's not a bad return, but it is notable in terms of a slowdown in performance going forward. We think investors can mitigate that with proper diversification. And why is that particularly important? Well, over time, the composition of the S&P 500 never stops changing. If you have a longer-term horizon, which stock investors should, of 10 years or more, you'll note that the top companies in the S&P 500 are constantly changing. In fact, even the last 5 years have noticed a notable shift as new companies come in and others exit. Now, the combination of strong performance and extreme concentration should make investors think twice about blindly following the S&P 500. And again, taking a look at the equal weight S&P 500 should be a prime consideration and also a good allocation in investor portfolios. Here's why. If you look back at performance of the S&P 500 market cap weighted index, which is frequently or almost always quoted in the media, versus the equal weight, you'll see that the equal weight index performs more often than the market cap weighted index. In fact, there are only 2 decades where the market cap weighted index outperformed the equal weight. And since inception, the equal weight on the far right has outperformed the market cap weighted. Ironically, the biggest decade of outperformance or disparity between the two was the 2000s, and early 2000 was the last time there was a near record concentration in the S&P 500 or an elevated concentration. While we don't think the market bears those similarities, it's a warning to investors to make sure they have proper diversification and not just chase the top 10 stocks in the S&P 500 whose earnings growth is slowing, but at the same time have some of the highest valuations they've ever had. I'm Anthony Valeri. Thanks for joining, and we'll speak to you again soon.